All right. Welcome everyone to our first Caddi panel. The topic is, can DeFi and CeFi coexist? Lessons from the past cycle and looking ahead. A little introduction. I'm Jaimin and I'm the CEO and founder of Caddi. Caddi is your crypto companion. It helps you navigate crypto with confidence. The extension makes every transaction safer and cheaper. We route you to the best prices across CeFi and DeFi. We're live on ETH, Polygon, and centralized exchanges too. We're currently running a beta, so feel free to reach out if you want access. We're pleased to welcome our panelists, Darren Camas, the co-founder and CEO of IPOR Labs. He's representing DeFi. We've got Pavir Patel from the CeFi corner. He's the chief of staff at Bitpanda Pro. And Alex McFarlane. He's the co-founder and CEO of Keyring Network, representing the compliance and bringing institutions to DeFi. If you have questions, feel free to leave them in the chat. We're going to do a round of introductions. I'll leave the panelists. How about we get Darren to introduce yourself first, and then we'll go round.
I think it was already a great introduction. So I've been building in the crypto space for actually this will be my 12th year, so a very long kind of view to the industry. So this DeFi space is really innovative. It's pushing the limits, and it has to be taken from a regulatory perspective as something completely new. And so my views will be maybe how we can reshape the view, how technology is pushing the bounds on the compliance side, because you can't necessarily just fit old rules into new constructs.
Awesome. Yeah. Sounds like you're doing some really important work to onboard the masses to DeFi. How about Pavir?
Hi guys. So I work at Bitpanda Pro. It's a centralized crypto exchange focused on spot right now, and is in the process of launching a regulated derivatives exchange offering. Hopefully first to market in Europe, which can serve both retail and institutions. We don't believe that user experience should be sacrificed when you get regulated. And so it's really important for us to kind of fulfill both kind of what users want to trade on the perps, which we've seen so much demand for in the past kind of couple of years, as well as trying to fit that into the current regulatory scope within Europe itself. Before this, I was at JP Morgan for a couple of years, so kind of TradFi background, and I've been with the company for about 1.5 years now.
Awesome to hear your background, Pavir. Sounds like the regulatory first approach doesn't sound too bad after I'm sure what we're going to cover in this, and love to hear from you, Alex, as well.
Hi, so I'm the CEO and co-founder of Keyring Network. So Keyring Network is a zero-knowledge compliance oracle, and we're focused on breaking the link between the KYC onboarding and the trading activity of the wallet that somebody wants to trade with. We see this as an important part of getting institutions into public ledgers and DLT more specifically, more generally, sorry. And it's a vital part of the ecosystem to preserve privacy across kind of institutional flows, client lists, and future transactions. In terms of like where this sits with everyone else, I think we're fairly complementary, and it's good to see some familiar faces.
Awesome. Well, these are the panelists, and we're going to be discussing the ins and outs of CeFi, DeFi. But before we do that, it'd be great to set some context. As it stands, it's the 16th of February. Bitcoin's around 24K. We've seen from the last cycle, Bitcoin going all the way down to 3K, doing more than 20x from the COVID lows to the peak bull of 69K. The market cap of crypto went all the way to 3 trillion, and now it's back down to 1. Trading volumes over 2022 have really fallen off a cliff. And we've seen the bull cycle, the hype and the speculation die down and be a bit tempered towards the more recent months. DeFi has gone through a full cycle, with DeFi summer in 2020 kicking things off. Luna imploded, obviously centralized lenders, a few others went under, Voyager, Celsius, BlockFi, as well as FTX collapsing. It's been a wild ride the entire time. Just love to get your thoughts on how can we avoid the same mistakes that we've seen of the last bull cycle of 2022. How about we start with Darren?
Okay, so maybe some of the mistakes, well, there's a lot of things that we can learn from this, but I think the first one, and something that maybe is a personal responsibility, is you can't underestimate human greed. And that goes from, the individuals that are playing, inside the markets, to the speculators, to people that are deploying too much leverage, to also the responsibility inside of the institutions themselves. Right. So I think, we need to be much better, on a personal responsibility, on self-regulating. Otherwise, the regulators will step in. And this is exactly what's happening, because people were doing what are really irresponsible things. But on the other side, from the regulatory side, we see this really large crackdown now in the US. But the rules haven't been really clear. And you have, for example, regulatory action from the SEC against Kraken for their staking service, and I believe he's chairman now, but the co-founder of Kraken, Jesse Powell, he's coming out and saying, tongue in cheek, oh yeah, if you just, all I had to do was come in and register, when it's never been clear, right? Also, this kind of lack of clarity on the registration side, on the compliance side, has led to institutions having to interpret the rules by themselves, in the Coinbase Earn or the Kraken staking as a service, or, for example, has led to some of this leveraging, on the GBC Trust, because it hasn't been allowed to be converted into an ETF. So, there's a lot of things that we can learn from this, and a lot of it is, self-regulation and also regulatory clarity.
I think as well, touching on Darren's points, because a lot of the regulatory backlash that we've seen that's hitting the press now is very US focused, but I think to me it just kind of highlights that crypto is kind of global by nature, and the regulations are very jurisdictional specific, as kind of these international boundaries don't have like common financial laws, let alone laws for crypto. So this stuff that's happening in DeFi is just kind of really new and hard to be consistent amongst multiple jurisdictions together.
Yeah, I think I'd agree with that point in terms of the patchwork of regulatory clarity. I think the benefit of traditional finance is that you have clarity across lots of different jurisdictions, and even within traditional finance, as we saw with Brexit, it was an absolute nightmare with banks figuring out what their responsibilities were with booking trades just between London and Germany or Paris, and they weren't sure which ones they were back-to-backing the books with. So in that respect, it's no surprise that when we have zero clarity, that it's just creating absolute chaos. And I think that has to be interpreted in the solutions that people are looking to provide. I think they have to be able to provide systems and solutions that will work with that kind of patchwork of regulation. I would say that in terms of regulators stepping in, I think that's actually a good thing in the long term. I think that generally it's always going to happen. What needs to happen is that there is a voice from the crypto community, particularly with experience, I would say, rather than just random degens, but experienced voices leaning into regulators to shape that regulation. I think it's just a real big shame that a lot of that was done by FTX in the US, which has caused a few problems, I think, going forward.
I think that when we look at things like MiCA as well, which is due to come out in Europe kind of next year, they haven't touched DeFi, which is actually really positive because they have kind of looked at it as a bit too new to regulate, and they have looked to enforce regulations around stable coins and centralized intermediaries. Probably where exactly as you're saying, Alex, that is needed, because those are kind of most similar to I guess existing structures which exist from the current TradFi world.
Yeah, so it sounds like this kind of lack of regulatory clarity is almost by design. That there's not a certainty of how in the future DeFi is going to be regulated, but that's kind of the regulators taking a back seat for the time being up to now, We've obviously seen, as Darren mentioned, the SEC cracking down, kind of regulating by enforcement for staking and Coinbase Earn. Yet that seems to be, the very first efforts to regulate. Obviously, SEC's case with Ripple has been going on for a while, but that's not the case for the majority of crypto. I'm just wondering if you guys think that that's going to change, and if so, like at what point? Obviously, MiCA will come out later this year. So, and particularly with US regulations too, they seem to be leading the way. Have you seen anything like that with Europe or even Asia too?
I'll just jump in that on Europe. Probably not many people have noticed yet, but in the last 36 hours, Europe has just made a big move on regulatory clarity. So they've released a European sandbox for doing specifically that. And they're going to be selecting 20 firms to sit in that sandbox who have innovative approaches to compliance and regulation for the European Union. My view on it is that I think that the clarity will remain unclear. From our partners, it seems, from our traditional finance partners, it seems to be that generally what's happening is that they're informally engaging with regulators and calling insiders that they know within the regulatory bodies to see what kind of activities are acceptable before they go ahead and do them. But to some extent, I don't think that's a new practice. I think that is prevalent in traditional finance. And I think if you actually look at the specifics of traditional finance and trading, a lot of the activities in traditional finance also have degrees of unclear regulation in some aspects, and particularly to do with like risk limits. So I don't think it's a particularly new thing to have that lack of clarity in some areas. I think it's just the extreme example with crypto. So I think that it will clear up. But I think I would push back at the US leading the charge. I think the US is, at the moment, I would say, rather doing a slightly odd scattershot across the industry on various different open battles. And
it seems just reactionary, right, in the US compared to MiCA, which has been way more thought out. I think is probably going to be the leading example of kind of how getting kind of crypto regulation right. I think they've themselves built up from engagement with like Singapore, which has also been pretty good in terms of the regulatory curve, and their sandbox has borne really good results and participation with like even JP Morgan on their kind of I think it was using a Aave and Polygon for FX transactions.
And I agree. Like, so, I'm from the US. I'm a US citizen now living in Europe, and seeing the different approaches, it's quite striking. But I think it also comes from maybe a fundamental misunderstanding of the technology also. I mean, if you look at some of the things, we're talking about, securities acts that were drafted, after the Great Depression. We use the term wire transfers, and I think the inside of FTX, they were joking about wire fraud. But wire fraud and the idea of a wire transfer is terminology coming from sending money over a telegraph along a railroad, right? So we have these very old constructs, but we have a very new technology. And so if you look at crypto or blockchain or distributed systems in general, let's frame it with another industry. So if you have something like Napster, which was a bane, to the music industry, to the motion pictures and TV, and it was regulated in the old way, right? Which is you take your court order, you shut down the servers. Then you have a new construct, which is like BitTorrent. It's a distributed system, and as much as it is even worse, for those industries, it's a genie out of the box. You can't stomp it out unless you close all nodes to the network, right? So it's a new construct, and you have to readapt to this new reality. But we have, like, let's say in the US, we have very old regulators that are used to very kind of different constructs. And it's actually not feasible, right? So to close down the node-based system, you have to close all the nodes, and this is kind of a basic misunderstanding that people don't have from the regulatory side. So if you don't understand this, then you're not going to be able to understand, one, that's not a feasible approach. So you also have to re-strategize and rethink. Then you guys mentioned about Switzerland and Singapore. So, I mean, these are much smaller countries that have a very active and, you know, I think in both cases, a single regulator that's looking at these things. And they're much more up to date on the technology, on the innovations. So it's also something that's very difficult to do at scale, you know, the size of the US or pan EU, though I think maybe EU is doing a much better job. But then you have like Singapore and Switzerland, which on that scale, the regulators can actually have this very deep understanding of the technology and adapt accordingly.
I mean, what we're doing for our derivatives exchange is really shoehorning the way in which other current derivatives exchanges, like a Binance OKX or even FTX, is set up into traditional finance market structures. So we are applying for like a MiFID license, which is like the big European financial regulation which came out in kind of 2016, and we're applying for a trading venue license. Now, the compliance of that is insane compared to anything any other exchange, centralized exchange, has to do. And so I think there's two ways that kind of you can kind of go about this. Is one, try and shoehorn, you know, a crypto business into existing regulations which work for a jurisdiction, or kind of the DeFi approach, which I'm sure Darren's much more down, which is okay, you get your crypto through a centralized intermediary as spot, and then once you're into DeFi, it's not regulated.
Yeah, you even mentioned like MiFID. Maybe this is kind of a hat tip. I didn't do a good job explaining what IPOR is, right? But IPOR is both a benchmark interest rate and it's an interest rate derivative platform, right? Built on Ethereum. It's DeFi, but actually, you know, MiFID is coming out of the LIBOR scandal, right? So the LIBOR scandal, of course, birthed from you know, collusion inside of banks, mostly using Facebook Messenger. And this is why we have these broader-reaching regulations around actually transmitting sensitive financial data over messaging systems. But for example, we take this construct of a LIBOR, like you know, an interest benchmark rate, and through the actual technology, it's one smart contract talking to other smart contracts that can't be falsified or spoofed. And it's setting this transparent benchmark rate. So you have things like this, these kind of innovations that take this new construct, they apply old things like benchmark interest rates, and they apply new constructs, which is like this kind of real-time transparency, this you know, kind of this volume-weighted approach that you can get instantly, you can get on-chain, it's provable, it's auditable, it's not manipulable. And I think this is a much better construct. But if you're looking at it from an old lens, this will never fit inside of these regulations because it's a different beast. And I think you know, Alex would know this very well because of his very specific background.
Yeah, I think, yeah, I mean, after I left Nomura, I think the majority of all the quant team were probably fairly fed up of changing all of the benchmark rates from LIBOR to others. The point I think is interesting that you brought up again was trust. And I think given the topic of the panel, I think that's one of the most interesting intersections between CeFi and DeFi. And it's one of the main areas that DeFi looks to solve. I think we had a big deep dive in terms of thinking about DeFi and like thinking about distributed ledger technologies more generically and how they're applicable. In our mind, we don't necessarily see DeFi as being so much of a thing rather than a tooling that people use in traditional finance per se. In the same way, I feel it's kind of strange when people say, oh, I love ERC 721s. I just reply and say, yeah, I also love JSON. It's a great technology too, because it's more about like how you use these technologies rather than the things themselves. And DeFi specifically is really shaped up to provide CeFi exchanges and traditional finance exchanges with the tooling that they can use to provide that trustlessness. And this is kind of something that IPOR does. It's something that Bitpanda are obviously doing the shoehorning into the regulation, to quote your words. And I think it's not necessarily one or the other. I think that generally it's a combination of the two that's always going to be the thing that pushes the industry forwards. I think that areas of centralized exchanges are very good. And I think areas, obviously, as we've seen with FTX and collapses in associated credit fallout, obviously suffer from trustlessness and benefit from the transparent nature of blockchain.
Absolutely. And I think, it's really interesting that you touched upon trust. I think a lot of trust has been lost, and this is from many participants in the ecosystem, whether that's retail traders who put money on FTX, in centralized lending platforms, or it's even from the traditional institutions who were ready to adopt, or it seems like towards the end of the bull market were ready to adopt crypto. JP Morgan's effort with Onyx. I'm just wondering, for traditional finance, is there a lack of understanding that you think is kind of preventing mainstream adoption? Do you think the technology is too early, or what is it that's really stemming kind of institutional adoption at this point?
Let me take that just really quick, about the FTX situation, right? And maybe contrast some blowups that were in the last run, right? So, for example, Celsius were misappropriating customer funds, right? They were also the biggest DeFi degens. We know this famous 0xB1 wallet, right? But, in all of the lack of transparency that we have in Celsius's books, the only real view that we could get to their assets was their repaying of their Aave debt, for example. So you contrast, centralized opacity versus decentralized transparency, and that I think is a really great case for DeFi. And then if you look at FTX, you have a lot of people that look at Sam and say, he looks like us. He reminds us of us. And people were trusting the person, and it turns out that the person was not rules-based. They weren't risk-based. They were actually doing very risky things. They were doing fraudulent things, likely. But it's the idea that, I can trust someone like me, but I don't trust his code. Sure, there's a huge, massive trade-off. In the code, you can have vulnerabilities. You can also have, let's say, the rugs. But, these are different trade-offs. And these will think we really saw people judging people that look like themselves but don't have these oversights and maybe act irresponsibly, and this is the output. This is the outcome of that.
There's no easy answers. I think. Look, you're either trusting, if you're self-hosting, you're basically trusting yourself, which is subject to loads of different risks, like the $5 wrench attack, for example, someone just kind of mugging you for all your assets. If you trust an intermediary, you're facing some counterparty risk. That's what we saw went wrong with FTX. If you're transacting on a DeFi protocol, then exactly as Darren said, right, you have that protocol risk and smart contract risk. So right now we're in a world where none of these risks are totally well understood. I think on the centralized intermediaries side, that is going to be from more regulation. I think from the self-hosted and DeFi side, I think it's things like smart contract audits, and then totally increasing and improving the wallet experience, which I personally don't think that private key management at an individual level is going to be the way forward there. Just to touch on like what is kind of like TradFi adopting as well, which I think was your question. I think they are quite open. It depends who you speak to, but they're quite open to the technology. That's why JP Morgan's had that like Onyx thing in the pipeline probably from around 2014, 15. It's been years in the making. Private permission fork of Ethereum, basically, which was then sold to Consensus. So I think from the technology perspective, exactly as Alex is saying, right, that stuff will be quick to adopt, but their participation in cryptocurrency markets, I think, is been set back by a couple of years from FTX.
Yeah, I think to answer your question about what is it from the banks? Is it lack of understanding? Is it whatever? I think it's very simple from their side. The benefits are, I think there's two areas of blockchain use. There's the private blockchain use, which you've mentioned, Pavir, And then there's also the public blockchain use, like general, which we all think of about being DeFi per se. Now, generally, obviously, there's massive operational savings that you can get from ledger technology. I think anyone that's worked inside a bank or a large institution, financial institution, knows about the data issues, about the operational issues, the booking problems that happen on a regular basis that cost a lot of money and can cause big losses. But I think one of the big areas that public networks are of interest to banks, it is not. I think a lot of people get confused and think, oh, they're going to start trading and make loads of money trading. I don't think that's necessarily what the main angle is here, because frankly, banks and hedge funds getting into trading and doing arbitrage, they're just shafting retail clients that could be their own clients. So I don't think that's a reasonable argument. The main angle, in my opinion, is distribution and trustlessness. We've seen time and time and again that banks and institutions get big fines for doing non-transparent pricing, offering better rates to different people based on fairly dubious terms. Some of the most interesting ones out of that can be seen as dark pools. I think every single bank that's ever operated a dark pool has had a fine from the SEC for operating some degree a lit desk within the dark pool. And that's a key area. That's the easiest example we use of that, which shows a trustless system is required that has privacy, and also probably has to be done on a public ledger for those reasons. The reasons that are stopping them from adopting this have been very simple from what we've heard. Number one is the overarching issue is KYC and AML, because that can cripple an entire business. The number two is the hack risk. And the KYC AML, obviously we're solving that, so you can consider that done, maybe. Maybe not, I don't know, depends who you ask. You ask me, I'll tell you it's done. On the hack risk though, hack risk is a lot more interesting, and I think that no one's really come up with a real good solution for that. Yeah, I won't get into that. It's a whole different topic.
It sounds like it's, from my perspective, it's very hard to quantify hack risk. You know, there's a reason why there's so few insurance protocols, like anything on chain. The fact that you can, you know, when you're storing money with a bank, it's, you know, it's insured, FDIC insured. There's nothing really outside of protocols being insured by very, you know, specific insurers that a user can have comfortability in having their funds completely insured, or even having a pool of funds which can be insured. Yeah, just wondering if you guys have at all like thought about the insurance space and what needs to happen from an infrastructure point of view to then start bringing that on chain.
I mean, from the custody perspective, it's they literally get like this species, like this criminal insurance. That's what's kind of protecting their assets. And I think there's the two forms, right? So there's one which is like, as a custodian, are they keeping your assets safe, and they have criminal insurance against that? Then the much more unknown one was the thing that you kind of mentioned, which is smart contract insurance, and that to me is still an unsolved problem.
So I would say, Jaimin, you obviously know my wife, like she's in insurance, so we talk about this quite a bit. I think one of the main issues there is, in reality, is the reinsurance problem. So the reinsurers have, I mean, if you think banks are backwards, I think you should go look at the reinsurance and how they do their modeling. Most of it's probably still a MATLAB, or probably even in Fortran in some cases. So the reality is they just don't have the models. I don't think big insurance houses have the sophistication to deal with what's frankly quite a niche market. Like if there was insurance premiums that were really significant, and as the market grows, yeah, Lloyd's are going to start looking at this stuff. But when you look at the amount of you look at the way the insurance market operates, it's not that efficient. If you've ever been into Lloyd's of London, it's incredibly old-fashioned, and I just can't see these guys actually putting the effort in while the monetary reward isn't there. And the smaller startups just don't have the warehousing capacity to warehouse the SKU that is required of them, because it's this classic strategy. These kind of insurance players is picking pennies up in front of a bulldozer. But fundamentally, unless they cap the risk of the bulldozer, then they just can't fundamentally stay alive if they ever do have to pay out. And if we have to cap the risk, then it's kind of pointless, because anyone significant is going to have far more risk than, say, $1 to $5 million, which is the most insurance that you can actually get. My view is, if we're going down that route of like to avoid at risk, which it seems that we are, my thoughts on that are a delayed settlement is the only way to achieve this, because that's what banks do currently. That when you'd be absolutely mad in an institution like a trading floor to think if you could if one of your juniors fat fingered a trade, then suddenly you're down the pan for $10 million immediately, and you have to then you don't know who the counterparty is as well. I mean, it's just, that would be an insane scenario. No one would ever do that. I mean, even if you look at FX, which is one of the most quickly settled contracts, like non-deliverable forwards are settled on T+2. And it's not that they can't settle them faster. It's because of all the cock-ups that the traders do during the day and put the wrong zeros on. And this is one of those things that it can be very easily fixed, I think. And smart contracts can also track the credit risk that daisy chains through the intraday trading links, because that's where a lot of the blowups happen, right? Because you have an intraday trade where one person's got credit risk, frankly, on an IOU until the settlement happens. And then it's that those IOUs don't get tracked and no one really knows what their credit risk is. And banks use like XVA modeling to try and figure out that and take a rough finger in the air. Using blockchain, you can exactly quantify exactly what their credit risk is, just no one's really done it yet. And I think I kind of see that as being the way it will go, because then you just don't need the insurance to some degree.
I think the settlement and like sending of transactions now, at least for the institutions, is a lot better than it was probably even 3 years ago. You know, all the custodians, Fireblocks Copper, we've got our own, have these kind of controls and, like, you know, whitelist addresses, who you sending it to, what smart contracts can you interact with, so your traders can only trade on like Curve and Aave, for example, can't use Tornado Cash, and those types of like threshold things. So if transactions above $1 million, it needs people to approve it. If it's, you know, less than $100, so they go through. So I think that's kind of more solved. But yeah, I think still the smart contracts and, you know, interacting with DeFi risks haven't been as well sorted out.
Maybe I can put in kind of the DeFi perspective, right? So even if we look at like CeFi, I think the BitMEX Insurance Fund is one of the largest Bitcoin wallets in the world. And that was a construct, you know, that they were very creative, you know, about doing. You have some of the smart contract auditors that are talking about putting up, you know, insurance funds around the protocols that they audit. You have something like Nexus Mutual, you know, as Alex mentioned, you know, they're not big enough to cover. And also who bears the bill? You know, is it the DAO? Is it the DAO Treasury? If it's the DAO Treasury, maybe they don't have enough diversified assets, so they cover it in the protocol token, which causes a, you know, maybe a market drawdown, and it's not enough to cover. So you have all these questions around it, but, you know, there are some attempts. Actually, I know a project that's working on the reinsurance project. They have the insurance license in Bermuda, but they're not touching DeFi. They are DeFi native. They're doing a parametric risk. It's called Insuro. And they're actually offering this as an alternative capital pool to traditional fintech startups. So they're not they're a DeFi protocol. They're working in insurance, but they're not underwriting DeFi risk. So that's kind of a funny thing. But Pavir, you mentioned also the custodians, right? So custodians are kind of an interesting thing, both from a regulatory and a technological perspective, right? And Alex, you mentioned you know, the responsibility of storing your own keys, which most of us can't keep our email password right without a reset. So now doing that with money is a very problematic thing. So, you know, this custodian space from a regulatory perspective on the TradFi is 100% necessary. From a DeFi or a crypto native perspective, it's the least necessary because it's built into the protocol. And then on DeFi, you have things like Gnosis Safe, which becomes your custodian. You can distribute keys amongst a number of providers. And this is now this kind of, or you can look at a DEX as a non-custodial exchange. It's not a decentralized exchange. It's a non-custodial exchange where the smart contracts are the custodians. So you have kind of this shifting of definitions. And that's kind of an interesting nuance between DeFi and CeFi.
That's really interesting. And I'd like to pick up on a little bit of what you mentioned, Darren. You said there was auditors who are also insurers as well. That model seems really interesting, where they can look at a protocol and they can basically, it's almost like stake how good their audit was. Just wondering, curious, like, have you at IPOR, have you been able to look at those models? Do they make sense for you guys to use yet? And how do you go about audits in DeFi?
Yeah, so we haven't yet. We just had a big TVL increase, so of course that's much more interesting. But then it goes back to who subsidizes the who pays the premium, right? Is it the end user? Is it the protocol itself? Is it coming from the protocol treasury? Is that treasury diverse enough to underwrite it? Is that liquid enough to cover the claims, right? So all of these are kind of unknown questions. A lot of the auditors in the space, they are basically verifying or certifying the quality of their audit by actually putting their own funds into the DeFi protocols. So that's kind of one stamp of approval, and then the other is kind of this insurance. You have other things like DeFi safety, which is trying to create this metric of what level of security does this have? Does it have any smart contract audits? Has it been hacked? What's the reputation of those auditors? So it's kind of a new security metric that's specific for DeFi.
Sure. It's really interesting. I'm actually talking to DeFi Safety about just vetting every contract that exists on typical DeFi protocols, and it's very interesting the risk scoring that they come up with. Whether it's accurate and over the long run, I guess we'll just see. We'll have to see whether it's accurate for people to quantify what risks they're exposed to. But I do think more of this kind of thing, where they review contracts, protocols, even the mechanisms under which they work, is really important. Now, kind of shifting gears, like we've had a lot of hype about kind of real world assets recently, and I'd just like to know, like, any of you guys thinking about that? Obviously, it's more of a DeFi thing, and kind of innovations around it, whether it's CeFi or DeFi, but it seems to be generating quite a bit of buzz.
So yeah, our kind of view is that there's going to be a lot of really high quality real world assets coming on chain this year. I think almost every week you see a new small regional bank has done some sort of bond issuance on blockchain now. Varying different applications of it, some doing it on public ledger, some doing it on private ledger, but generally I think that there's going to be a lot of uptake. The most interesting thing, frankly, are the real world assets on chain, and this is something which we're wondering about at the moment, which we haven't kind of got a concrete answer for, is in terms of who's getting the interest from like a US Treasury bond. Because one of the most interesting things in my mind is if you can take say 20 million US Treasuries, let's say 100 for easy maths, $100 million US Treasuries currently paying like 4.5 at 3 months, then you can drop those potentially into like MakerWorld real world asset, or like maybe even Arve's Ghost real world lockup. Now, it's not clear to me who gets the interest, because if you still got the interest on that, you've got a pretty kick-ass opportunity there, because you can then take that USDC that you get out the back of it, and you can dump that into something like Maple Finance to get another 10% out. And then, frankly, you're laughing, right? Because you've effectively got a 15% yield for doing pretty much nothing, because these kind of institutions you're lending to are very high quality, and you're really able to just double dip on the interest there. So I think that's one of the coolest things that is in real world assets currently. I don't think many people have thought about that, and I think there's going to be, frankly, a lot of ETFs that come out with that structure. I think the one thing that's going to happen is going to put a lot of pressure on traditional finance asset managers, if the theory I just have is actually correct, because I'm not convinced it is correct. Because obviously, if somebody's able to generate 15% just with very little effort, you're going to have a lot of pressure put on mutual funds and asset managers with that.
Yeah, I think this bridging is really interesting, right? On the bridging of real world assets, you always have the issuer risk, right? Because they're essentially verifying or the existence of the asset, right? That's something that you can't get away from if something is not blockchain native, right? But also you can say that for USDC, USDT, BUSD, right? So you always have this kind of issuer risk. That said, what Alex said also, and something that's interesting in DeFi, And specifically, to the IPOR targets is you have this kind of inversion of yields, right? During DeFi summer and post, you could see 10%, 20%, 30% per annum on your stable coins, and that's off of the over collateralized markets. And if you get into some of the riskier ones, you can maybe see a higher rate of return. Now those yields have collapsed to 2%, which means you're getting half of what you could get on a U.S. Treasury. Right, and one of the issues is that you don't have really efficient bridges to be able to arbitrage these two markets. And maybe some of the keys to that are, one, having the infrastructure, maybe having the KYC, and also having the instruments that you can actually play, between these different markets. And really, you should have these efficiencies be arbed away, right? So we also have some investors and partners that are actually launching structured products that will be a basket of different assets, with different yields, whether it be treasuries, that exist off chain, whether it be real estate assets, and also some on chain assets. So this is kind of a very nice, diversified structured product that is also possible.
I think when we applied for a license, we definitely had in mind how can we serve tokenized assets too, which I kind of categorize as like a lot of the real world assets present. And again, the regulatory area here isn't too precise, because obviously you have the issuers, but once something's on chain, it can be kind of freely traded and owned by any crypto wallet holder. So it's kind of where again the regulatory clarity is not amazing. We look at this as a potential advantage for us, because when we have our license granted, we can distribute and market these tokenized assets very freely, because we'll have the right regulation to do so within Europe itself.
Yeah, that's really interesting, because that's actually the problem we solve, is the transferring of real world assets, tokenized real world assets, or any kind of ERC20s. That's exactly what the problem we're solving is that the issue is that with, say, if you've got like gilts, or you've got US Treasuries that are tokenized, there's a large number of people in the world that can't hold those because of the sanctions that are implicit on those individuals, particularly US Treasuries. I think you'd be in a lot of issue with US Treasury bills if you start distributing those to unaccredited US retail investors. So that's a particular problem set you can solve for by kind of using a compliance oracle, frankly. And that's actually one of the main reasons why we've got quite a lot of interest from the traditional finance sphere, because it's that issue of distribution, which can be highly problematic in there.
Yeah, that's really interesting, actually. Just wondering also, like with zero knowledge technology, it does seem that, this is what's needed to kind of confirm that you are a user or you're not a user of something, that you have some certain property about this wallet or the way you interact on chain. And that's, definitely within your wheelhouse, Alex. I'm just curious as to what you see kind of the future over the next few years being in that space in terms of, well, privacy, compliance, everything else on that front.
Okay, so zero knowledge is like, now you're delving into areas where I've been doing a lot of active development on, but I wouldn't say I'm an expert in. So I may say incorrect statements here, which may be slightly imprecise. My view on the zero knowledge area is that there's a lot of different applications of zero knowledge, and that creates a lot of confusion for people who are outside the applied side of it. So in terms of how does zero knowledge apply to compliance, there's two real families of the way, well, there's three real areas that zero knowledge is used for in blockchain, full stop. Number one, everyone's kind of familiar with is like zero knowledge scaling, right? It's just the roll up kind of, but let's put that to the side because it's got a little to do with compliance. The compliance areas though are largely privacy and self-sovereign identity. Now the self-sovereign identity is effectively like you get your passport, you do OCR, so you extract the data from your passport, put it in like a data blob, a flat structure, and then you assign each bit of data blob roughly, because we're not doing this, so different people might do this in different ways, but it seems to be the way people are doing this is taking individual areas of like what's called a Merkle tree and allowing, which is a hash of hashes, and then allowing people to reveal certain parts of that blob of data without revealing the whole. And that's attractive because it effectively, well, according to the proponents, it means that you're in custodian of your own like passport or PII data, as they call it. Now, there's other people that say that's not the case because they say even if it's encrypted, it's still on the blockchain, and then that might cause problems with GDPR. But we stay kind of largely clear of that debate. There's a second area, which is what we're more focused on, which is the privacy aspect. So that comes out of Semaphore technology, which the Ethereum Foundation's privacy team have developed. And it's to do with the idea of mixing identity, so you have crowd-sourced anonymity effectively. So what you can do with that aspect is you're remaining anonymous in like effectively a pool of other users that look identical to you. So there's no way of pinning down exactly who you are. And that's kind of similar to when you're trading, right? If you're executing a trade in traditional finance, you'll largely try and avoid executing more than say 1% of the daily volume, because otherwise you stick out from the crowd, you're going to move the market, people will identify your trading activity. So it's a similar kind of concept there, and you have actually similar concepts with Keyring. Some of the analysis we've been doing more recently is to figure out what kind of volume you need per day to get a certain level of anonymity in terms of other users that look the same as you. So in terms of where I see this going, I think that the CBDCs are the most interesting endpoint around this, because they're hugely controversial. A lot of people, including myself, are very skeptical of how they will be implemented. And there's a lot of ways in which they could be implemented in a slightly sketchy way, or very sketchy way in a lot of cases. So I think that the zero knowledge component will be extremely important once the public realize that, for things like CBDCs and privacy in the real world scenarios. And that refers to both the way of tracking people's compliance and ensuring like they're compliant with certain transactions, and also being able to have anonymous cash transfers. Because remember, with Web3, you're not just you're associating your entire financial history in public. And I think there's a lot of need to kind of just wrap this up. I think there's a lot of need, frankly, to allow a lot of that kind of like low level, it sounds bad, but allowing that kind of like low level activity that people just don't care about, like a builder does something slightly dodgy on his tax receipts. And those kind of activities aren't really, HMRC kind of let those sort of things slide generally. I mean, explicitly they don't, but I think unless people think they can get away with that kind of small kind of stuff, then I don't think anyone's going to pick this stuff up, because if they don't feel they can get away with things like that, then it means that if there's any kind of if there was ever a central body overreach into their personal finances, then they would have big problems. So that's where I see the zero knowledge thing going, to be honest.
Awesome. Yeah, I didn't mean to drop you in it like that as well, but I appreciate your answer.
Maybe to add on there, so you know, it's also interesting. It's privacy is a must inside of financial institutions, right? So if you look at, there's you know, Zcash, I think it's called the Electrical Coin Company, and they were hired by JP Morgan to work on their blockchains to try to add a privacy layer. You also have Corda by the R3 conglomerate, and it's focusing on privacy only for the transactions that are needed, right? So inside of the financial institutions, it's extremely important, you know, inside and also between financial institutions. And as Alex mentioned, actually DeFi it's not private, right? It's actually very public. And I think it's a very kind of crazy misnomer that people think of crypto as these anonymous people running around. Yes and no. For example, there was just an attack designed specifically for the IPOR protocol that was about 3 weeks ago or 2 weeks ago, where you had a single attacker that was flushing up the utilization rate on Aave and Compound, trying to you know, take advantage of a swap. And because of the technology, we can just go onto Etherscan, track the attacker addresses. They lead back to one address. That address has multiple ins and outs of about 10 million to Binance, and realize, you know, this is a very sophisticated basically market manipulator that has a very close relationship to Binance. So something like that, if it was inside of a financial institution and I wasn't a regulator, I wouldn't be able to know. But because I have access to the Ethereum blockchain, I can understand it very easily, very quickly, and understand this behavior pattern. So privacy is, it's a very important thing, and it's really mischaracterized that crypto is very private, because it's not.
Couldn't agree more with that. Yeah, I do think the next wave, if we really want to see mainstream adoption, we have to have some sort of private transactions. It's just the way the world works currently outside of crypto. But it's, privacy opt-in, or whether it's by default, that definitely needs to happen. And we can have, zero knowledge to help prove certain actions or properties about your transactions, which is absolutely fine. But it seems like the next layer of infrastructure, which is built, does have to be, have some sort of privacy attached to it. And that kind of brings me on to the next thing. We've got the market is, well, we've seen a brief rally actually over the last month since the start of the year. I'd love to know your take on the market outlook for the next 2 years. Are we going to see a bull run? Is it going to happen soon? Is this a scam pump? I'd love to hear your takes on the market.
Can I just kind of comment briefly on that? Are we talking Bitcoin relative to the S&P, or are we just doing macro trading here?
Anything you like.
Because I think there's two points of view, right? I mean, if you're saying will Bitcoin and ETH go up, then really the question is, how is the S&P going to go up? And I think that's a question that I don't know if many people are qualified to answer within DeFi. But I think if you're looking at whether the spread between ETH and the S&P is going to increase, I think inevitably, it's going to go up by quite a considerable amount. And I think also that we may see the volumes in ETH versus Bitcoin start to overtake. I think there's a lot of activity moving more towards a smart contract rather than the I hate the system, I want to remain anonymous, with Bitcoin sort of degen trading. I think a lot of the Bitcoin activity in the past has been largely because it's just got high volumes and is attractive for people to trade. Whereas I think Ethereum has the actual utilization as a result of the smart contract technology. However, there is some interesting stuff going on with Bitcoin, and I can't remember what the hell it is. Someone just chucked a Bored Ape Yacht Club onto Bitcoin somehow. I don't know how, but whether that is going to actually have any utility remains to be seen.
We're a year before the halvening, and so usually there's this trek up before the halvening. It gets less, I guess, important every cycle, but I think that's the big Bitcoin catalyst.
It's pretty interesting, right? Because I think the inflation narrative was always really strong for a reason for people to own Bitcoin and kind of debasement of dollars and basically money printing overall. And we have seen actually the kind of the demand for Bitcoin kind of be sustained at this kind of 2020 level too, which is definitely more than you mentioned, right, in the COVID in the COVID downturn, which is really interesting. I think there's going to be these many narratives which play out. I think zero knowledge proofs is definitely one. The AI one is another. So I think there's going to be these pumps and these random narratives because I think there's still this appetite for a bit of degen trading somehow with the people who are still left in the crypto space. Yeah,
it does seem that even since we came up from 16K, there's been a lot of people, like Twitter has been going crazy, people trading NFTs. The appetite for speculation hasn't fully gone away. I did want to leave some.
Look at Blur. Who's in that one?
Unfortunately, didn't get the airdrop. But I wanted to leave a bit of time for audience questions. If there's anyone in the audience who wanted to ask anything to any of the panelists or more generally, it'd be great to hear from you.
Oh, Jaimin, you're on mute,
Jaimin.
Nicholas has raised a hand, so yeah, feel free to unmute and ask a question.
Hello guys, thanks for the panel. It's excellent coverage of a lot of big hurdles and pain points of the industry. So my question relates to identity and AML compliance with respect to adoption from institutionals to DeFi. So do you think that business model should be, let's say, relying on the DeFi protocol, developing their own network, such as Aave is actually proposing with the archive, or do you think that the business model will be a single integration layer that could be interoperable with different solutions that will then be used by institutionals without any change at the DeFi protocol level?
I guess, shall I take that first? Okay, there's three ways you can do this, and I think being flexible for all three is the way, right? So you can have the blockchain way of basically scanning transactions in the mempool. You look at Flashbots, for example, do that. If you look at the Aave Arc model, that's the way of doing it at the protocol smart contract level. And then finally, there's a way of doing it. There's the third way of doing it, which is doing it at the asset level itself, i.e. the ERC20 level, or if you're doing it in NFTs at the NFT level. I think generally the one that is getting most traction at the moment is doing it at the NFT level or the ERC20 level, because that means that you don't have to re-audit smart contracts of the protocols, and that you can travel between protocols freely. I think that the blockchain itself, permissioning the mempool, is problematic in a lot of different ways. Because basically it's just difficult to implement and get people on board with. And also, frankly, I think also bear in mind there was a NETH community call about a month and a half ago that said they'd all quit if that happened. So that's also a big negative on that. So yeah, I think generally the ERC20 level is generally what's going, and that's what we're seeing interest for at the moment. Although particularly if it works with things like Aave Arc as well, that's a massive benefit too.
Thank you, Alex.
I was talking with these guys. They had a very interesting approach, right? So let's say if we mentioned Tornado Cash, right? Tornado Cash was sanctioned, what was it, by OFAC? And one of the pushbacks was that people started spamming all these influencer addresses with coins from Tornado Cash, which would automatically be added to the sanction list, right? And that's kind of showcasing, one, maybe the overreach of this, two, the lack of ability to enforce it. But these guys that I was talking with, they took a very interesting approach, which is maybe a more blockchain native approach, which I think would be very unlikely to then get adopted by financial institutions. But they were looking at doing like a risk-based approach rather than a KYC-based approach, which is essentially using on-chain verification through something like Elliptic or Chainalysis to maybe do like a dirty or risky money score analysis of the composition of a pool. And I thought that was maybe a very interesting or clever way to do this.
Thank you, Darren.
Yeah, so I've noticed that we're coming up to the hour, and it's been a lot of fun. So thank you guys, panelists, for joining. We'd like to just ask if you have somewhere where someone could find out what you're doing, how to contact you, what you're working on, then love to get socials or just a place where they can find you.
Yeah, sure. So for IPOR protocol, you can find everything on IPOR.io as an inter-protocol overblock rate. Most of the conversations happen on Discord. There's a very active Twitter. There's a lot of documentation for developers, for quants, for community. There's a lot of focus on education around interest rates and interest rate derivatives. Yeah.
Ours is Bitpanda Pro, so on Twitter, LinkedIn, and Pavir Patel on both of those as well. We, as a reminder, are a centralized exchange looking to launch regulated derivatives in the next couple of months.
For me, I would say probably contact Jaimin and he'll give you my Telegram to throw him under the bus there. It's probably the easiest way, because if I tell you how to get hold of us, it's going to be difficult to pronounce all the letters and you just won't get it right.
Appreciate it. Well, thank you so much, guys. Yeah, it's been a great panel, a great discussion, and I think the audience and myself have learned a lot. It's been great to hear your views. I'm very excited about both CeFi, DeFi, and everything in between. I think the future, hopefully it's not too long till good markets return. And remember, if you need to trade, you want better prices, you want to stay protected from scams, definitely use Caddi. We're onboarding, the first 1,000 users via whitelist. And yeah, looking forward to having you test out the platform. So thank you so much. Have a good one, guys.
Thanks, guys.
Thank you.
Thank you.